Hello and welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, everyone knows when to buy a fund, but rarely does anyone tell you when to sell a fund. We'll tell you 4 reasons when you should get out of a fund in today's conversation. Welcome, Dhirendra.
Thank you.
So, Dhirendra, the most common trigger, let's talk about that. Markets fall, funds fall, investors, they exit the fund. Is that ever the right call?
Almost never. When the markets fall, every fund falls. And it may be an excellent fund, it may be an outstanding fund. And it is nearly impossible for any equity fund to escape a market fall or a sustained market fall. The magnitude can change. Your fund can fall little more than the market, little less than the market, or substantially less or substantially more than the market. And that will be for the reason, and that will be compensated. If you have chosen a fund carefully for the reasons, it is nearly impossible to escape a market decline. And the reason why you invest in an equity fund is that this is an investment for a couple of years. You should not be investing. But most people are guided by the market fall because they are guided by the market rise. Investors choose fund because it went up sharply in the recent past, and that is why they choose. That is why they run to get out of it the moment it falls freely.
So, now let's come to the reasons when one should actually get out of a fund.
Most of the reasons when you should sell a fund is normally you yourself. You need the money. You need to plan your exit. You invested steadily. You invested systematically. And you should disinvest systematically when you need it, well before you need the money. Planning your redemptions well before you need it, which is before a goal. Second is that the fund has changed. You chose a good fund. It was a diversified fund. And now it is acting funny. It got concentrated. You looked at some of the reasons, and then it is now losing its sheen. Losing its sheen meaning it is unable to beat benchmark over a sustained period of time. That is a good enough reason, which means that the reason why you bought the fund in the first place, that reason itself has disappeared. And this can happen with plenty of funds. But you can't do it based on last 6 months or last 1 year. You have to give it a time of 18 months to 3 years to really understand, because these things don't change. A fund does not change its character or its complexion in such a brief period of time. The second is that most people start with a wrong selection. You came across a fund, you liked the story, you bought the fund because you liked the story, and then the story stopped working. If you invested in a fund because it was doing exceedingly well and you took a measured bet and it has stopped working because the premise has changed. Many people would have invested in a defense fund or a manufacturing fund or a services sector fund, and at a time when after which it worked, and then it stopped working because the complexion of the market, it is little narrower, it is not as diverse. And the fund manager is constrained by doing that. We have seen this with many thematic, many sectoral fund, many constrained fund. So if you're in a diversified set of vehicle, and there the fund manager has lost its mojo, so to say, he has lost his sheen. His instincts were sharper. Now he is not. He goes wrong often. And that has started showing in, last 1 year of disability or inability to beat the benchmark consistently. And that is why you choose an actively managed fund. Give it some time, because and there are good fund managers who are out of favor for a period. Many of their stories don't work out all the time. Some of their instincts are not well timed. It works, but it comes with a delay, or it requires some patience. There could be many such things. So that is a reason. If you lose hope, but do it for a reason, not just because the market has gone down and your fund has gone down. That is not a good enough reason, because if you're investing for the long run, have the discipline, have the patience that comes, and have the reason before you buy a fund. And that is why you should have a reason why you should sell a fund. Then there is one more reason, that you have a fund which is doing okay. And it was doing very well when you started investing. It continued doing very well for a long period of time. And then it has stopped doing well. Extraordinarily well, but it is doing okay. It is not a disappointing fund. And now it has been an average or a not disappointing, but a decent fund, an okay fund for a long period of time. And you have choice of investing in a fund which will do better. It can actually will flex and perform better. Make a choice. You can give up on an okay fund for choosing in favor of a better performing fund.
Right. Now, can you give us a list of wrong reasons, the ones that investors usually sell their funds for, but they shouldn't actually be doing so?
most people make a proclamation that my fund went up by 40% and that is why he sold it.
So booking profit.
Booking profit. People think that if they book profit, then they need to, they have to, they should, otherwise that profit will slip away. But my sense is that it's a compounding vehicle. The moment you sell a fund, the next challenge is, if you don't need the money, then your next challenge is, where do you put it? Where to invest? And people are, they normally have a sense that once the money actually comes back home, that has been locked for a while, and then you put it to work, then the mental resetting happens. You feel happy that, okay, you have realized again. But that the reason why a fund did very well is the reason why it might continue to do very well. The other is the reverse of this situation, that because it went up, you sold. And likewise, because it went down very dramatically, you sold. I invested a lakh of rupees and it went down to 75,000 rupees, and then I lost my patience. So a steep fall is disappointing. Third is, I think is primarily a comparison, that I have a good fund, it is doing well, but my friend's fund is doing much better. Why not have that? But the point is that it is all a function of the then prevailing time. It was the context which is the primary driver. There's a possibility that your friend's fund, which was doing very well, starts doing simply doing poorly or doing okay. And you will actually have the privilege of that ride from there on. We are always guided by the past performance. And this is time when you should be reminded of the statutory disclaimer that past performance cannot be achieved. It's just indicative, and it is no reflection of the future performance. But it is so well entrenched that we look at the past and we think that is how we should be guided.
Right. So you've told us when to exit, when not to exit. But how should I go about investigating the reasons?
Just compare it with a benchmark. And there is one reason which you should look at it a little more objectively, which is a flip on our rating. A fund slips from 5-star to 4-star is a reason to be watchful but not to worry. 5-star to 3-star is also a reason to be watchful, not to worry. That, okay, its relative risk-adjusted performance has slipped. If it slips from 3-star to 2-star, then I will worry, and there must be a reason. And normally this is a reason that it is now getting into an arena of sustained underperformance relative to its peers. There are superior alternatives available, and it is now a lingering underperformance which translates into this kind of... So this is a rating which should trigger more intense thinking about should you sell it. So that is the only other reason which comes to my mind, that should be a trigger, should be an objective case for evaluating your choices and options more with clarity.
All right, so one last question. I have finally investigated all the reasons and I'm ready to sell. How should I avoid a big tax implication?
You can't avoid. Taxes and death, I was told that, they are non-negotiable. You can worry about it. If you are selling for your own goal, then you can navigate it a little bit. Because think of it, most of us, we think of investment as a lump sum, and we think of disinvestment as a lump sum. Don't do that. Do it based on your need, and plan it. So if it is for your child's education who is getting into the college a year from now, take the first year fee, not the whole thing, because the whole money will not be needed on day one. And you have still, taken the first year's tuition fee and put it in a fixed income fund, so you don't have to worry. Likewise, so you can negotiate a little bit, and that way you are able to defer your taxes. Then you have the normal entitlement that every year you have a capital gains limit which you can avail. Second is that if there is one more thing, it is a tax. It's a tax management. It's not a tip. It's not a loophole. You can offset your gains with losses. So if you are sitting on losses somewhere, you can just sell and buy that fund, and that will translate into losses in your books. Assuming that you have a fund where you invested 5 lakh rupees and now it has become 4 lakh rupees. You sell it and you buy it next day, and you plan to hold it for a long term. You sell your 5 lakh rupees fund that you bought for 4 lakh rupees, and you have now 1 lakh rupees of gains, of losses. If you have 1 lakh rupees of gains elsewhere, it can offset that. So this is the only trick which is available, which is legitimate and can be exploited a little bit. But I think don't worry about taxes. And if you are selling a fund because it has stopped being well, and you should not, if you look at a fund and if you have some money to invest, if you will not invest in the fund today, objectively, that is a good enough reason for you to not have your investment in that fund as well.
So investigate well before you decide to sell. Sell because of the fund or your own reasons, not because of the market. We'll see you next week.